Good day, everybody. We are from BSA IS2B Group 1. We are going to present the Chapter 3 Revenue from Contracts with Customers. Its learning objectives are: first, state the 5 steps in the recognition of revenue. Second, describe how performance obligations are identified in a contract. Third, describe how the transaction price is allocated to the performance obligations. Fourth, state the timing of revenue recognition and its measurement. Fifth is to state the presentation of contracts with customers in the Statement of Financial Position.
PFRS 15 provides the principles in reporting the nature, amount, timing, and uncertainty of revenue and cash flows arising from an entity's contract with customers. Its core principle is an entity recognizes revenue to depict the transfer of promised goods or services to customers in an amount that reflects the consideration to which the entity expects to be entitled in exchange for those goods or services. What is the difference between income and revenue? Income is increases in economic benefits during the accounting period in the form of inflows or enhancement of assets or decreases of liabilities that result in increases to equity, other than those relating to contributions from equity participants. Income encompasses both revenue and gains. On the other hand, revenue is income arising in the course of an entity's ordinary activities. PFRS 15 applies to contracts wherein the counterparty is a customer. Contract. It is an agreement between two or more parties that creates enforceable rights and obligations. A contract can be written, oral, or implied by an entity's customary business practice. While customer is a party that has contracted with an entity to obtain goods or services that are an output of the entity's ordinary activities in exchange for consideration. In revenue recognition, an entity applies the 5 following steps when recognizing its revenue. Step 1. Identify the contract with the customer. In identifying the contract with the customer, the contract with the customer is only accounted for only when all of the following criteria are met. First, the contracting parties have approved the contract in writing, orally, or impliedly from customary business practices and are committed to perform their respective obligations. Second, the entity can identify each party's rights regarding the goods or services to be transferred. Third, the entity can identify the payment terms for the goods or services to be transferred. Fourth, the contract has commercial substance. Example, the risk, timing, or amount of the entity's future cash flows is expected to change as a result of the contract. And last, the consideration in the contract is probable of collection. When assessing collectability, the entity considers only the customer's ability and intention to pay the considerations on due date. When a contract does not meet the following criteria, no revenue is recognized. Any consideration received from such contract is recognized as liability and recognized as revenue only when either of the following has occurred. First, the entity has no remaining obligation to transfer goods or services to the customer and all, or substantially all, of the consideration has been received and is non-refundable. Or, the contract has been terminated and the consideration received is non-refundable. The entity need not reassess the criteria above if they have been met on contract inception unless there is an indication of a significant change in the facts and circumstances. For example, when the customer's ability to pay subsequently deteriorates significantly. If the criteria are not met on contract inception, the entity shall continue to assess the contract to determine if the criteria are subsequently met. PFRS 15 is applied over the duration of the contract. Example, the contractual period, in which the contracting parties have present enforceable rights and obligations. A contract does not exist if each contracting party has the unilateral enforceable right to terminate a wholly unperformed contract without compensating the other party. A contract is wholly unperformed if the entity has not yet transferred any promised good or service to the customer and has not yet received or not yet entitled to receive any consideration. Two or more contracts entered into at or near the same time with the same customer or related parties of the customer are combined and accounted for as a single contract if the contracts are negotiated as a package with a single commercial objective. Second, the amount of consideration to be paid in one contract depends on the price or performance of the other contract. Last, some of or all of the goods or services promised in the contracts are a single performance obligation. Here are a sample illustration of identifying the contract with a customer. ABC Co. sells industrial printing equipment to a customer for $5 million. The customer pays a $1 million non-refundable deposit and issues a long-term note for the balance. The customer obtains control of the equipment at contract inception. Additional information is that the customer intends to open a publishing business. The equipment acquired from ABC Co. will be the main asset of the business. The business is located in an area where the market for publishing businesses is overly congested. The customer will need to compete with large and long-time established companies to get a market share, and the customer has a little experience in the publishing industry. The customer intends to repay the loan primarily from income derived from the publishing business. The customer has no other significant source of income that can be used to repay the loan. The financing arrangement is on a non-recourse basis. The analysis are the customer's ability and intention to pay the balance of the consideration is in doubt because of the following reasons. First, the customer intends to pay the balance of the consideration, which is significant, primarily from income derived from the publishing business, which faces a high risk of failure because of high levels of competition and the customer lacks experience. Second, the customer lacks other sources of income that can be used to pay the balance. And last, the financing arrangement is on a non-recourse basis, meaning if the customer defaults, ABC Company can repossess the equipment but cannot seek further compensation even if the collateral does not fully cover the unpaid balance. Conclusion is, ABC Company shall not recognize any revenue from the contract. ABC Company shall treat the $1 million non-refundable deposit and any subsequent collection as deposit liability. Revenue shall be recognized only when the collectability of the considerations becomes probable or when either of the following occurs. First, ABC Company has no remaining obligation to transfer the equipment to the customer and all, or substantially all, of the consideration has been received and is non-refundable, or the contract has been terminated and the consideration received is non-refundable.
Step 2. Identify the performance obligations in the contract. A contract includes promises to transfer goods or services to the customer. Well, it is a certain promise in the contract to deliver to the customer either some good or service, or a bundle of goods or services that is distinct, or a series of goods or services that are almost the same. So for example, when you sign up for monthly cleaning services or for monthly accounting services, and these services are basically the same each month. A contract usually explicitly states the goods or services that should be transferred to a customer. So we considered it as explicit performance obligations. But sometimes there could also be implicit performance obligations that are implied by something. For example, by entities' customary business practices, or some guarantees that company usually provides to all customers without explicitly saying that in the contract. Now, when there is no transfer of anything to the customer, then there is no performance obligation, and I want you to remember that. For example, when some company must buy new IT system in order to fulfill the contract, and it must perform some set of activities. So these activities transfer nothing to the customers, so there are not a performance obligations. Here in the second step, the crucial thing is to assess whether the performance obligations should be treated separately for accounting purpose, or in other words, whether they are distinct.
Step 3, determine the transaction price. The entity determines the transaction price because this is the amount at which revenue will be measured. So, transaction price, it is the amount the anticipate to receive from the buyer as a result of the services or products offered by the seller. So, without a doubt, this is what the seller anticipates as payment for the services or products offered. In simple terms, the transaction price is another term for the selling price. So, sa transaction price, kailangan din natin to do background check sa ating mga client when we are doing IFRS 15. If paano ba ang business practices nila regarding the transaction price. Kasi baka meron silang trend or nakasanayan na accounting estimate na gagamitin nila, which is according to the standard. So, kapag may trend na, alam mo na kung paano i-determine ang transaction price. So, pwede mo na siyang estimated variable consideration or most likely amount which be tackled by Remabel. Dito, excluded ang amount collected on behalf of the third parties. So, now, according to the paragraph 48 of FIRS, when determining the transaction price, an entity shall consider the effects of all the following. Yun nga, number 1, variable consideration. Number 2, existence of a significant financing component. Number 3, non-cash consideration. Number 4, consideration payable to a customer.
Step 4. Allocate the transaction price to the performance obligations. The transaction price is allocated to each performance obligation identified in a contract phase and the relative standalone prices of the distinct goods or services promised to be transferred. Standalone selling price is the price at which a promised good or service can be sold separately to a customer. A list price or a contract price may be the standalone selling price of a good or service. If it's not directly determinable, it shall be estimated. The following methods may be used to estimate the standalone selling price. First is adjusted market assessment approach. The entity evaluates the market where the goods or services are sold and estimates the price that a customer will be willing to pay for those goods or services. Second is expected cost plus a margin approach. The entity forecasts the expected cost of satisfying a performance obligation and then adds an appropriate margin. Third is residual approach. The standalone selling price of a good or service is the residual amount after deducting all the standalone selling prices of the other promised goods and services in the contract from the total transaction price. A combination of methods may be used if two or more goods or services have highly variable or uncertain standalone selling prices. Here is a sample illustration of allocating the transaction price. ABC Co. sells product X, Y, and Z to a customer for a lump sum price of 90,000. The products will be delivered to different points in time. In case 1, related standalone prices are determinable. ABC Co. regularly sells product X, Y, and Z separately at 20,000, 40,000, and 60,000 respectively. To allocate the transaction price to the performance obligations, we need to multiply the lump sum price of 90,000 to every standalone prices of each product. And as allocated, product X has 15,000, product Y is 30,000, and product Z is 45,000, total of 90,000. The differences between the standalone prices and the allocated amount shall be treated as a sales discount. On the other hand, in case 2, related standalone prices are not determinable. ABC Co. does not regularly sell the product separately. Therefore, the standalone selling prices of the products are not directly observable. To estimate the standalone selling prices, ABCco has gathered the following information. First, the prices at which other competitors regularly sell products similar to products X and Y are 25,000 and 45,000. ABC Company cost of releasing product Y is 60,000. ABC Company regularly marks up its product at 20% above cost. To allocate the transaction price to the performance obligations, the estimation method used for product X is adjusted market assessment. For Y, adjusted market assessment. For say, expected cost plus a margin. In allocation, we need to multiply the 90,000 lump sum price to the estimated prices of each product. Then divide it to the total of estimated prices. As allocated, products X is 15,845, Y 28,521, and Z 45,634, a total of 90,000.
Step 5. Recognize revenue when or as the entity satisfies a performance obligation. It is satisfied when a promised good or service is delivered to a customer or transferred, and that happens at the moment when the control of that good or service is transferred. Two different ways of satisfying a performance obligations. It could be overtime. So, in this case, the revenue is recognized over time too, and this means that you would need to recognize a revenue gradually over the contract period and not as a single amount when the contract is completed. For example, some real estate development projects or construction contracts are usually on overtime basis. It can be satisfied at the point of time with revenue recognized at the point of time. And it sets 3 criteria when you need to recognize revenue over time, and if one of them is met, then it's overtime. Otherwise, it's at a point of time. So timing of revenues has tremendous impact on everything from the financial health of a company to its taxes. It's important to take care about it.
Satisfaction of performance obligation. A performance obligation is satisfied when the control over a promised good or service is transferred to the customer. So, ano ba yung control? Control is the ability to direct the use of and obtain substantially all of the economic benefits from an asset. So, benefits include the potential cash inflows or savings in cash outflows that can be obtained directly or indirectly in many ways, such as by using the asset to produce goods or provide services. Number 2, using the asset to enhance the value of other assets. Number 3, using the assets to settle liabilities or reduce expenses. Number 4, selling or exchanging the asset. Number 5, pledging the asset to secure a loan. And number 6, holding the asset. So the entity determines at the contract inception whether a performance obligation will be satisfied either over time or at a point in time. So you can recognize revenue either over time or the point in time. When you say over time, pwedeng unti-unti, alam mo yun? At each reporting date, you can assess kung magkano na yung revenue na pwede mong i-report. Pero kapag point in time, usually kapag meron ka ng transfer of control, which may be at the end of the contract pa. So, sa overtime, unti-unti, habang umaandar kontrata mo, nagre-recognize ka ng revenue. On the other hand, sa point in time at a completion or transfer ng control, which may be at completion, which is dulo na siya. Kung ako si seller, magre-report ako ng revenue. Ano ba ang mas applicable or mas okay na gamitin? Overtime ba or at a point in time? Syempre, doon sa mas maaga ako makakapag-report ng revenue. Kaya binigyan ng condition ni PFRS 15 na dapat daw before you can recognize revenue over time, hindi to option na. Dapat makamit siya ng isa dito sa tatlong criteria. Kapag point in time naman, meron ng transfer ng control. So, ano nga ba yung tatlong criteria na dapat kahit isa lang ma-meet mo to recognize revenue over time? Tapos, kapag wala kang na-meet dito sa criteria na ito, definitely, sa point in time ka na. So, performance obligation satisfied over time. Revenue from a performance obligation that is satisfied over time is recognized over time as the entity progresses towards the complete satisfaction of the obligation. A performance obligation is satisfied over time if one of the following criteria is met. So, ito na yung tatlong criteria. Ang unang criteria ay the customer simultaneously receives and consumes the benefits provided by the entity's performance as the entity performed. Example, doon sa, ang tawag doon, sa phone at load, basta yung plan, yon. 'Di ba kapag nag-subscribe ka ng plan, bibigyan ka ng cellphone, tapos every month bibigyan ka ng load. Di ka naman bibigyan ng load sa end ng contract bibigyan ka ng load every month over time. Tapos, yung load na yon, pwede mo siyang gamitin. Kailan? Doon sa dulo pa ng kontrata? Siyempre, hindi rin. Every time, 'di ba? Every month kung monthly yung subscription mo. So, the customer simultaneously receives and consumes the benefits provided by the entity's performance. Every month, nagpapadala ng load. Every month, nare-receive ng benefit. Nakaka-receive ng benefit. At nagbe-benefit doon si customer. Definitely, you can recognize that in a period of time. So, doon yung sa network services natin. Doon sa mobile plan. Pwede ko siyang i-overtime revenue recognition. Number 2. The entity's performance creates or enhances an asset that the customer controls as the asset is created or enhanced. Example, kunwari, nagpaparenovate ako ng bahay. So, sino may control doon sa lupa? Doon sa asset na lupa? Siyempre, ako, 'di ba? Pero sino yung nagpa-perform or nag-enhance ng house ko? Of course, the constructors. In that case, the entity's performance creates or enhances an asset that the customer controls. Ang may controls ay si customer. So, ako yung may control doon. So, in that case, pwede akong mag-overtime revenue recognition. Number 3, lastly, the entity's performance does not create an asset with an alternative use to the entity, and the entity has an enforceable right to payment for performance completed to date. For me, ang pinaka-common na example nito ay ang mga customized goods. 'Di ba kapag customized goods, wala namang alternative use kay constructor or kay manufacturer or kay seller, and it is not generally available in the market. Pwede mo pa yan i-bill end anytime kasi nag-order siya evidence per his order. So, you can use overtime revenue recognition. So, kapag wala kang na-meet sa tatlong yan, you will use point in time. So, usually, kapag na-deliver mo na yung control or na-transfer mo na yung control to the customer. So, measuring progress towards complete satisfaction of a performance obligation. An entity recognizes revenue for each performance obligation satisfied over time by measuring the progress towards the complete satisfaction of that performance obligation. The entity uses a single method of measuring progress for each performance obligation satisfied over time and applies that method to remeasure its progress at the end of each reporting period. So, meron tayong ginagamit na dalawang method. Yung una doon ay ang output method. Ang progress ng pagme-measure dito ay based on the direct measurements of the value of the goods or services transferred to the date relative to the remaining goods or services promised under the contract. For like example, service of performance completed to date, o kaya naman appraisal of results achieved, milestone reached, ganyan. So, yung pangalawa naman is yung input methods. So, sa under ng input method, yung progress nito ay mina-measure based on the efforts or inputs expended relative to the total expected inputs needed to fully satisfy a performance obligation. For like example, cost incurred, resource consumed, labor hours expended, machine hours used, ganyan. So, next naman, performance obligation satisfied at a point in time. A performance obligation that is not satisfied over time is presumed to be satisfied at a point in time. So, revenue from performance obligation that is satisfied at a point in time is recognized when a performance obligation is satisfied. So, the entity considered the following indicators of transfer of control when determining the point in time at which the promised good or services is transferred to the customer. So, number 1, the entity has present right to payment for the asset. Number 2, the customer has legal title to the asset. Pero, however, the entity is not precluded from transferring control of an asset to the customer if the entity retains the legal title solely to protect the collectibility of the transaction price. In that case, revenue may nevertheless be recognized. So, di na siya ma-recognize. Number 3, the entity has transferred physical possession of the asset. Number 4, the customer has the significant risks and rewards of ownership of the asset. Number 5, the customer has accepted the asset.
In summary of revenue recognition, step 1, identify the contract with the customer. The contract is with the customer and the collectibility of the consideration is probable. Step 2, identify the performance obligations in the contract. Each promise to deliver a distinct good or service in the contract is treated as a separate performance obligation. Step 3, determine the transaction price. The transaction price is the amount that the entity expects to be entitled to in exchange for satisfying a performance obligation. Step 4, allocate the transaction price to the performance obligation. The transaction price is allocated to the performance obligations based on the relative standalone prices of the distinct goods or services. For step 5, recognize revenue when a performance obligation is satisfied. For performance obligation satisfied over time, revenue is recognized as the entity progresses towards the complete satisfaction of the performance obligation. For performance obligation satisfied at a point in time, revenue is recognized when the entity completely satisfies the performance obligation. Revenue is measured as the amount of transaction price allocated to the performance obligation satisfied. Here's a sample illustration to show the 5-step method of recognizing revenue. On January 1, 20X1, entity A enters into a contract with a customer for the sale of a machine and related 1-year maintenance services for a total contract price of $1 million. Entity A regularly sells these items separately. If they were to be purchased separately, their standalone selling prices are as follows: 900,000 pesos for the machine and 300,000 for the 1-year maintenance services. Entity A transfers the machine and collects the total contract price on February 1, 20X1. The maintenance services starts on that date. In step 1, identify the contract with the customer. Contract qualifies for accounting in accordance with PFRS 15 because all the requirements are met. In step 2, identify the performance obligations in the contract. There are 2 performance obligations in the contract. First is to transfer the machine and second, rendering of maintenance services. Each of these is a distinct good or service. In step 3, determine the transaction price. The transaction price is 1 million. In step 4, allocate the transaction price to the performance obligation. The transaction price is allocated to the performance obligations based on their relative standalone selling prices. Step 5. Recognize revenue when a performance obligation is satisfied. The promise to transfer the machine is a performance obligation satisfied at a point in time because it does not meet any of the conditions for a performance obligation satisfied over time. The promise to provide the maintenance services is a performance obligation satisfied over time because the customer simultaneously receives and consumes the benefits from the maintenance service as they are rendered. Hence, Entity A recognizes revenue of $750,000 on February 1, 20X1 when the machine is transferred to the customer. Entity A recognizes revenue from the maintenance services over the one-year contract period as the services are rendered.
Application of basic concepts. Step 1. Identify the contract with the customer. On August 1, 2028, Andrea Company entered into a contract of sale with Dave. The contract is structured such that Andrea must deliver the goods on September 30, 2028 and Dave must pay $80,000 on October 31, 2028. The cost of goods transferred is $65,000. Requirement: provide necessary journal entries on A. August 1, 2028, B. September 30, 2028, C. October 31, 2028. So, sino ba yung may revenue? Ang may revenue is yung seller. That's why all the throughout of the discussion sa part tayo ni seller, wala tayong pakialam kay buyer, seller lang. Noong August 1, 2028, yung seller at buyer ay nag-entered into a contract of sales. But apparently, there is no performance yet. Hindi pa nagpe-perform si seller or si buyer noong August 1. So, if there is no performance yet, we don't have any contract asset or liability, kaya no entry muna siya. Noong September 30, 2028, the cost of goods transact, which is Andrea the seller, delivered the goods. So, there is a performance on the point of view of the seller because nagkaroon ng delivery yet wala pang payment. So, we should recognize it as contract asset. Kaya noong September 30, 2028, ang debit niya ay contract asset or account receivable na $80,000 and ang credit niya na sales na $80,000. Another journal entry will be made if we are using the perpetual inventory method. So, dito naman sa part na to, yung debit dito ay cost of goods sold na $65,000 at credit na inventory na $65,000. Tas last, noong October 31, 2028, dito naman, nagbayad na si buyer. So, if nagbayad na si buyer, pareho na sila nag-perform. If both parties did perform already the contracts, wala nang contract asset. So, kaya ang debit na dito ay cash na $80,000 at ang credit na dito ay contract asset or account receivable na $80,000. Step 2. Identify the performance obligations in the contract. On May 1, gagawin ko lang itong 2031, ABC Co. sells a non-standard security device to a customer. The customer is billed on that day. The contract does not require ABC Co. to install the device because the installation is simple and the customer can do it himself. Neither does ABC Co. have a past practice or a published policy of installing such device. However, on May 3, 2031, a sales representative of ABC Co. helped the customer install the device because the customer had trouble understanding the instruction on the device user's manual. So dito, ang answer, the installation is not a performance obligation because it's not included in the contract, whether implicitly or implicitly. Revenue is recognized on May 1, 2031. So, ginawa ko na siya 2031. Step 3. Determine the transaction price. Andrea enters into a contract with Dave to install a music system together with its software. On January 1, 2028, Dave pays Andrea an upfront fixed fee of $50,000 for 6 months of featured access. Dave also will pay Andrea a bonus of $30,000 if Dave can use the music system anytime without experiencing technical difficulty during the 6-month period. Andrea estimates a 70% chance that it will achieve the usage target and receive the 30,000 bonus. So requirement, how much is the expected value of the contract price at inception, and B, how much is the most likely amount of the contract price. So, under the expected value approach, once again, in order for you to determine how much will be the transaction price, all you have to do is to get the sum of all possible amounts after multiply the same to their corresponding probability. So, we have two possible amounts. Yung possible one, yung 50,000 plus 30,000 bonus with assumption na marireceive yung bonus, or that's equal to 80,000. Tapos yung possible amount 2 naman is that we are not able to provide or to satisfy the condition, therefore we're not receiving a bonus. So if that's the case, the amount that we can expect from the client will only be equal to 50,000. So once again, according to the client, there is a 70% chance that it will achieve the usage target. Therefore, if there are only two possible outcomes, here the other outcome will have a chance of 30%. So the expected value approach for possible amount 1 na 50,000 plus 30,000 is equals to 80,000 times 70%. And yung possible amount 2 na 50,000 times 30%. So, dun sa possible amount, ang sagot ay 56,000 and sa possible amount 2 is 15,000. So, under the expected value approach, our transaction price will be equal to 71,000. Yun yung 56,000 plus 15,000. Kaya ang sagot sa letter A ay 71,000. So, the letter B naman, the most likely amount approach as transaction price will be equal to the possible amount which has the greatest chance of appearance. Yung may pinakamataas sa percentage, and obviously, that's 70%. Ibig sabihin, under the most likely amount approach, our transaction price now will be equal to 80,000. Hindi na siya i-multiply, wala nang ibang gagawin, kundi yung most likely amount ay 80,000 na mismo. Kaya yun yung sagot sa letter B. Step 4. Allocate the transaction price to the performance obligation. It will be discussed later on additional concept related to Step 4. Step 5. Recognize revenue when or as the entity satisfies a performance obligation. ABC Co. is a systems developer. During the year, ABC was engaged to develop a automated system for the billing and collection of a electric cooperative for a total contract price of 6 million. As of December 31, 2031, okay, 2031 ulit yung ginawa ko. The system is only 70% complete. However, ABC Co. had already billed the client for 90% of the contract price, or 5,400,000, and collected 4,860,000. Therefore, after 10% rent by the client to be reverted to ABC at the close-out date of the contract. So, how much revenue shall ABC recognize during the year? So, 6 million is the transaction price times 70% completion. So, ang sagot ay 4,200,000. Why? Because the progress billings and collections on those billings do not affect the measurement of progress. Contra cost. It specifies the accounting treatment of cost to obtain a contract and cost to fulfill a contract. Costs to obtain a contract are incremental costs. In other words, costs that would not have been incurred without obtaining that contract. For example, sales commissions paid for the acquisition of the contract. Another type, legal fees with the preparation of the contract. Bonuses to employees is specifically provided for obtaining a contract and other. It requires capitalizing these costs if entity expects to recover them and amortize them on a specific basis. Basically, reflecting the pattern how the goods and services are transferred. Costs of fulfilling the contract are costs incurred in connection with satisfying performance obligations, and the standard says that if these costs are in the scope of some other standard, like IS2 inventories or so on, then you need to treat these costs in line with the relevant standard. If these costs are not within the scope of outer standard, then this cost should be capitalized or recognized as an asset if they meet the conditions specified in PFRS 15 to do so. Amortization and impairment. Contract costs that are recognized as assets are amortized on a systematic basis that is consistent with the transfer of the related goods or services to the customer. The amortization is updated for any significant change in the expected timing of transfer of the related goods or services to the customer. Ito naman daw yung isang systematic na batayan upang maayon yung paglipat ng mga nauugnay na goods or services sa customer. Tapos yung amortization naman daw ay naa-update siya sa anumang makabuluhang pagbabago sa inaasahan na oras tungkol sa paglipat ng mga goods or services to the customer. In addition, impairment loss is recognized in profit or loss as follows. Number 1, recognize impairment loss in accordance with another standard. Number 2, recognize impairment loss in accordance with PFRS 15, which is the excess of the assets carrying amount over. And lastly, the resulting carrying amount after applying step 2 is included in the cash generating unit or CGU to which the assets belongs for the purpose of applying PAS 16 impairment of asset to the CGU or cash generating unit. Presentation. A contract is presented in the statement of financial position as a contract liability or contract asset. Contract liability is an entity's obligation to transfer goods or services to a customer for which the entity has received consideration or the amount is due from the customer. Ito naman yung obligation ni seller na i-transfer yung goods or services sa customer kung saan ang entity ay nakatanggap ng consideration o amount na dapat bayaran mula sa customer. Contract asset is an entity's right to consideration in exchange for goods or services that the entity has transferred to a customer when that right is conditioned on something other than the passage of time. Ang example naman dito ay yung entity's future performance. Kaya kailangan magkaroon ng right to consideration in exchange for goods or services.
Customers unexercised right. A prepayment received from a customer is recognized as a contract liability because it represents the entity's obligation to transfer or to stand ready to transfer goods or services in the future. On the other hand, the prepayment gives the customer the right to receive those goods or services in the future. Revenue is recognized only when the entity transfers those goods or services. However, there may be cases wherein a customer may not exercise all its contractual rights. Those unexercised rights are often referred to as a breakage. A breakage that results from a non-refundable prepayment is recognized as a revenue in proportion to the pattern of rights exercised by the customer when the entity expects that it will be entitled to the breakage or when the likelihood of the customer exercising its remaining rights becomes remote.
Additional concepts related to Step 2. Step 2, identify the performance obligation in the contract. Warranties. It is common for an entity to provide a customer a warranty for a product or service sold, whether in accordance with the contract, the law, or the entity's customary business practices. The nature of warranty can vary significantly across industries and contracts. Warranties may provide the customer assurance that the related product will function as the parties intended because it complies with agreed upon specification or service in addition to the assurance in above. So, warranty ay isang assurance na binibigay ng isang company kung saan yung product na binili mo ay gumagana in accordance to its function. For example, kapag bumili ka ng product and it turns out defective ito, dito papasok yung warranty will provide you a service wherein they will exchange it for a functioning product. So warranties are accounted for as follows: a warranty that provides the customer service in addition to assurance that the product complies with agreed upon specification is a performance of obligation. Accordingly, a portion of the transaction price shall be allocated to it. This is usually the case if the warranty is sold or negotiated as separate product. However, a warranty that is not sold as a separate product is nonetheless treated as a performance obligation if the customer is provided service in addition to assurance that the product complies with agreed upon specification. So the entity shall consider the following when assessing if a warranty provides a customer with a service in addition to the assurance that the product complies with agreed upon specification. Letter A, whether the warranty is required by law. So dito typically exists to protect a customer from the risk of purchasing defective product. Yun yung sa warranty is required by law. Pinoprotektahan nila yung customer nila para hindi sila protektahan yung customer from most likely protektahan sila sa bili ng defective products, ganon. So letter B, the length of the warranty coverage period. The longer the coverage period, the more likely that the warranty is performance obligation because it is more likely that a service will provide in addition to the assurance that the product complies with agreed upon specification. Letter C, the nature of the task that the entity promises to perform. Tasks that the entity necessarily needs to perform in order to provide the assurance that a product complies with agreed upon specification likely do not give rise to a performance obligation. Example, the entity shoulder the freight for defective units to be returned. So a warranty that neither provides the customer service in addition to assurance that the product complies with agreed upon specification nor is sold separately is not performance obligation. Principal versus agent consideration. So first, i-differentiate muna natin kung ano ba ang principal at agent. A principal, sabi dito, a principal may personally satisfy a performance obligation or it may engage another party to satisfy some or all of performance obligation on its behalf. So, the second one, the entity is an agent if its performance obligation is to arrange the provision of goods or services by another party. So, meaning, pag principal, siya yung entity na may control sa mga goods or services before i-transfer ito sa customer. So, kapag na-perform na niya, i-recognize ni principal yung revenue as gross amount. Kapag agent naman, siya yung nagbebenta. Hindi ikaw yung may-ari ng binebenta mo, pero makakakuha ka ng commission doon. So, the following are indication that an entity is an agent and therefore does not control the good or service before it is provided to a customer. Letter A, another party is primarily responsible for fulfilling the contract. Letter B, the entity does not have inventory risk before or after the goods have been ordered by customer during shipping or on return. Letter C, the entity does not have discretion in establishing prices for the other party's good or services and therefore the benefit that the entity can receive from those goods or services is limited. Letter D, the entity's consideration is in the form of commission. And letter E, the entity is not exposed to credit risk for the amount receivable from a customer in exchange for the other party's goods or services. Consignment arrangement. Under a consignment arrangement, an entity called the consignor delivers goods to another party called the consignee who undertakes to sell the goods to the end customer on behalf of the entity. So, magkakaroon lang ng revenue or i-recognize lang ni consignor ang revenue kapag naibenta na ito ni consignee. Kasi yung control over the asset is transferred to the customer. For example, si A isang consignor at meron siyang products worth 100,000 pesos na ibibigay niya kay B para ibenta. Si B, isa siyang consignee. So, ma-recognize lang ni A ang revenue kapag naibenta na yung products. Indicators of a consignment arrangement. Letter A, the product is controlled by the entity until the specified event occurs, such as the sale of the product to a customer of the dealer or until a specified period expires. Letter B, the entity is able to require the return of the product or transfer the product to a third party, such as another dealer. And lastly, the dealer does not have an unconditional obligation to pay for the product, although it might be required to pay a deposit. Customer option for additional goods or services. Customer option to acquire additional goods or services for free or at a discount come in many forms, including sales incentives or other discount on future goods or services, contract renewal option, customer reward credits or points. A customer option is accounted for a performance obligation if it provides the customer a material right that the customer would not receive without entering into the contract. Sales incentives, customer award credits or points, contract renewal option, or other discount on future goods or services are only some of the ways customers might obtain additional goods or services for free or at a reduced price. If an entity grants a customer the option to purchase more goods or services as part of a contract, that option only creates a performance obligation in the contract if the option provides the customer with a material right that it would not have otherwise. For example, a discount that is incremental to the range of discount typically given for those goods or services to that class of customer in that geographical area or market. Even if a customer has the option to purchase an extra good or service at a price that reflects the stand-alone selling price for that good or services, the option does not give the customer a material right. In certain circumstances, the business has made a marketing offer that it must account for under this standard only if the client chooses to acquire the additional goods or service. So, ang common example na to ay pag bumili ka ng bulk orders. For example, bumili ka ng 5 cake. Ang gagawin doon is parang bibigyan ka ng discount ni seller. Ganun. Customer loyalty program. Oftentimes, entities provide customer with incentives to buy their goods or services through customer loyalty programs. Under such program, the customer earns award credits, often described as points, from his purchases. Points can be exchanged for free or discounted goods or services. Ang common example dito is customer loyalty card. 'Di ba kapag customer loyalty card, nag-iipon ka ng points doon, and then kapag napuno mo na 'yon or kapag nakaipon ka na ng points, pwede mo siyang magamit in future events, like kunwari nakaipon ka na, pwede mo siyang magamit either i-discount sa'yo yung product or pwede siyang ibigay sa'yo for free. Non-refundable upfront fees. Sabi dito, in some contracts, an entity charges a customer a non-refundable upfront fee at or near contract inception. Example, include dito yung joining fees in health club membership contracts, activation fees, in telecommunication contracts, setup fees in some services contracts, initial fees in some supplies. So, the upfront fee is treated as a performance obligation if it relates to the transfer of distinct goods or services to the customer. The upfront fee is not treated as a performance obligation if it relates to administrative tasks to set up a contract. Setup activities are not performance obligation because they do not result in the transfer of promised goods or service to the customer as the tasks are performed. An entity may charge a non-refundable fee in part as compensation for cost incurred in setting up a contract or other administrative task.
Additional concepts related to Step 3. Step 3. Determine the transaction price. In determining the transaction price, the entity shall consider contract terms, customary business practices, the nature, timing, and amount of consideration, and the effects of the following First is the variable consideration. If the consideration includes a variable amount, the entity shall estimate the amount to which it will be entitled in exchange for transferring the promised goods or services to the customer. Second is concerning estimates of variable consideration. The estimated amount of variable consideration will be included in the transaction price only to the extent that it is highly probable that a significant reversal in the amount of cumulative revenue recognized will not occur when the uncertainty associated with the variable consideration is subsequently resolved. The amount of variable consideration can be estimated using either of the following methods. First is the expected value. The sum of probability-weighted amounts in a range of possible amounts. This may be appropriate when the entity has a large number of contracts with similar characteristics. Second is the most likely amount. The single most likely amount in a range of possible amounts. This may be appropriate when there are only two possible outcomes. For example, an entity either achieves a performance bonus or does not. Illustration for variable consideration with implicit price concession. ABC company sells equipment to a new customer in a new region for $2 million. At contract inception, ABC company determines that the region where the customer operates is undergoing economic difficulty. Therefore, ABC company expects that the consideration will not be collected in full. However, ABC company believes that the region's economy will recover in the near term and that the equipment will help the customer increases its sales. Accordingly, ABC company expects to provide the customer a price concession and concludes that it is probable that it will collect $1 million from the customer. And the analysis will be the consideration is variable because of the implicit price concession. Therefore, ABC Co estimates the amount to which it will be entitled in exchange for the equipment. If the other revenue recognition criteria are met, ABC company shall recognize revenue in the amount of $1 million. A discount is given to a customer if the transaction price is less than the sum of standalone selling prices of a bundle of goods or services promised in a contract. In the absence of evidence to the contrary, the discount is presumed to relate to all of the performance obligations in the contract and therefore should be allocated proportionately to all of them. There is no accounting problem here because the discount is automatically allocated when the transaction price is allocated to the performance obligations based on the relative standalone prices of the goods or services. However, when there is observable evidence that the discount relates to one or more but not all of the performance obligations, the discount shall be allocated only to the performance obligations to which the discount relates. Sale with the right of return. A customer may be given the right to return a product sold for various reasons, such as dissatisfaction with the product. In such case, no revenue is recognized for the products expected to be returned. A refund liability is recognized for the portion of the consideration received that is expected to be refunded to the customer. A refund liability should be updated at each reporting period for changes in circumstances. The adjustment may result in a corresponding increase or decrease in revenue. An asset is recognized for the entity's right to recover products from the customer on settling the refund liability. A promise to accept a returned product during the return period shall not be treated as a performance obligation but rather an obligation to provide a refund. Exchanges of one product for another of the same type, quality, condition, and price are not considered returns.
Third is the existence of a significant financing component in the contract. When determining the transaction price, the promised consideration shall be adjusted for the effects of the time value of money if the timing of agreed payments explicitly or implicitly provides the customer or the entity with a significant benefit of the financing transfers of goods or services to the customer. The core principle when adjusting the promised consideration is that the revenue recognized shall reflect the cash selling price. the price that the customer would have paid had he paid for the goods or services outright in cash. The customer does not have a significant financing component if first, the customer paid in advance and the transfer of goods or services is at the customer's discretion. Second, a substantial amount of the consideration is variable and contingent on the occurrence or non-occurrence of a future event that is beyond the control of the customer or the entity. Third, the difference between the promised consideration and the cash selling price arises from reasons other than financing. The promised consideration need not be adjusted for the effects of a significant financing component if the consideration is expected to be collected within 1 year from the date of transfer of the goods or services. Illustration of significant financing component. Transaction A. On December 29, 20X1, ABC sold goods costing $200,000 for $250,000 to a customer who was granted a special credit period of 2 years. ABC normally sells the good for $220,000 with a credit period of 1 month or with a $5,000 discount for cash on delivery. How much is the revenue recognized in the contract inception? To compute for the cash price equivalent of the goods sold, which is the fair value of the consideration, the $5,000 discount given for the outright payment in cash is deducted from the normal selling price of $220,000 with credit period of 1 month. Transaction B. On December 31, 20X1, ABC sold goods in exchange for a $1 million non-interest-bearing note that matures on December 31, 20X4. The implicit rate of interest in the contract is 12%. How much revenue is recognized in the contract inception? To compute for the revenue, we need to multiply the face amount of non-interest-bearing note, which is the $1 million, to the present value of 1 peso at 12% in 3 years. So the revenue from sale of present value of the note is 711,780. On transaction C, on December 29, 20X1, ABC sold goods for $30,000 to a customer who was granted credit period of 3 months. The goods were delivered at contract inception. The cash selling price of the goods is $28,000. The revenue recognized is $30,000, the contract price. Fourth is the consideration payable to a customer. This pertains to cash amounts payable to the customer or to other parties that purchase the entity's goods or services from the customer. It also includes the credit or other items that can be applied against amounts owed to the entity. Consideration payable to a customer is treated as a reduction to the transaction price, except when the payment is in exchange for a distinct good or service that the customer transfers to the entity. If the consideration payable to a customer is treated as a reduction to the transaction price, the reduction is recognized at the later of the following events. First, the revenue is recognized for the transfer of the related goods or services to the customer. Second, the entity pays or promises to pay the consideration. If the consideration payable to a customer is in exchange for a distinct good or service, the payment is treated as a regular purchase from a supplier. Illustration for consideration payable to a customer. ABC Company, a manufacturer, enters in a 1-year contract to sell goods to a customer who commits to buy at least 15 millions of the products during the year. The contract requires ABC Company to make a non-refundable payment of $1.5 million to the customer at the inception of the contract. This payment will compensate the customer for the changes it needs to make to its shelvings to accommodate ABC's product. ABC Company concludes in accordance with PFRS 15 that the payment to the customer is not in exchange for a distinct good or services that transfers to ABC Company. This because ABC Company does not obtain control of any rights to the customer's shelves. In the first month of contract, ABC Company transfers goods worth $2 million to the customer. What amount of revenue is recognized in the first month of the contract? Since the consideration payable to the customer is not in exchange for a good or services that transfers to ABC Company, the $1.5 million payment shall be treated as a reduction to the transaction price. The reduction is allocated proportionately to the revenues recognized during the contractual period. As each performance obligation is satisfied, the revenue recognized is reduced by 10%. To compute the consideration from delivery in first month, which is $2 million, we will be deducting the reduction of revenue $2 million million times 10%, which is 200,000. It will result from revenue from delivery in first month, which is 1,800,000. Fifth is the non-cash consideration. A non-cash consideration shall be measured at fair value, or if fair value is not available, at the selling price of the good or service promised to be transferred to the customer. If a customer contributes goods or services to facilitate the entity's fulfillment of the contract, the contributed goods or services shall be treated as a non-cash consideration if the entity obtains control over them. Illustration of non-cash consideration. ABC Company renders service to a customer in exchange for equipment with carrying amount of 100,000 and fair value of 80,000. How much revenue is recognized from the transaction? Answer is 80,000 pesos. The fair value of the equipment. If the fair value of the equipment is not available, the revenue will be measured at the selling price of the service rendered.
Additional concepts related to Step 5. Step 5. Recognize revenue when or as the entity satisfies a performance obligation. Bill and hold arrangement. A contract under which an entity bills a customer for a product but the entity retains physical possession of the product until it is transferred to the customer at a point in time in the future. So, ang sabi dito, the result when buyer is not yet ready to take delivery but does take little and accepts billing. Kunwari, sabi ni customer, seller, i-hold mo muna, wala pa akong space or paglalagyan dito pero babayaran ko na or singilin mo na ako. Habang hindi pa na-obtain yung control, wala pang nare-recognize na revenue. Kapag naman nakuha na ni buyer or customer yung control sa goods, all of this consideration should be considered. Consider all the following. Yung una, substantive reason for holding. Dito naman, na-request muna ni customer na i-hold yung goods ni seller. Tapos yung goods separately identified. Ito naman, binayaran na ni customer, so sa kanya na yon. Next, goods ready for physical delivery. Dito, nag-aantay na lang yung goods na ipadala kay customer. And last, the entity cannot use or sell. Ito naman yung hindi na ito pwedeng ibenta sa ibang customer under bill and hold arrangement. Layaway sale. The goods are delivered only when the buyer makes the final payment in a series of installments. So, ito naman yung purchasing method in which consumer places a deposit on an item to lay it away for later pickup. It lets the customer make smaller payments on the product until the purchase is paid in full. Ina-ensure na yung customer will get their chosen merchandise once it's fully paid. Again, bill and hold arrangement is the delay is due to a customer request, while the layaway sale, the delay is due to a seller request. For example, on January 1, ABC Co. sells goods to a customer for 24,000 payable in 12 monthly installments. The contract states that delivery will be made only when the customer fully pays the consideration. So, dito naman, mare-recognize lamang ang revenue ng ABC Co. kapag yung final installment ay na-receive na at yung delivery ay tapos na. Until that date, all collections will be recognized as a liability. Repurchase agreements. The entity shall consider any repurchase agreements on the asset when evaluating whether control is transferred to the customer. Ito naman yung agreement where an entity sells an asset but retains a right to repurchase the asset. Hindi siya dapat i-considered as sale but bilang low substance over form. Ibinenta niya ito ngunit ginawa niya itong security asset. So, repurchase agreements generally come in three forms. A. An entity's obligation to repurchase a asset or a forward. An entity's right to repurchase the asset, a call option. And C. An entity's obligation to repurchase the asset at the customer's request, a put option. So, yung put option, repurchase price lower than the original selling price. If yes, the customer has economic incentive to exercise repurchase option. The contract is accounted for as lease accordance with PFRS 16 leases. Pero walang nare-recognize na revenue kung yung purchase price is equal or more than the selling price. The contract is accounted for financing arrangement. Forward and call option. If the repurchase price is less than the original selling price of the asset, the contract is accounted for as a lease in accordance with PFRS 16 leases. If repurchase price is equal to or more than the original selling price of the asset, the contract is accounted for as financing arrangement. Time value of money should be considered when comparing the repurchase price with the selling price. If the option is elapses unexercised, the liability is derecognized and revenue is recognized. Contract modifications is a change in the scope and or price of a contract that is approved with the contracting parties in writing, orally, or implied by customary business practices. Scope or price, or both of these, the modifications can either be treated as a separate contract or not. The separate contract, if the two conditions set out in PFRS 15 paragraph 20 are satisfied. If either of these conditions are not satisfied, then the modifications cannot be treated as a separate contract. To determine how to further account for these modifications, let's move forward for not a separate contract. We need to determine if the goods or services are distinct, not distinct, or combination of both distinct and not distinct. If the goods and services are distinct, then the modified contract would replace the existing contract. The revenue that was already recognized would not be adjusted, and the future revenue would be adjusted on a prospective basis. If the good or services are not distinct, then the contract modification is treated as part of the existing contract. This would require retrospective adjustment. If the goods or services is a combination of distinct and not distinct, then the treatment would be a combination of the new replacement contract combined with a modification to the current existing contract. And last, changes in the transaction price. After contract inception, the transaction price can change for various reasons, including the resolution of uncertain events. Tapos dito naman, change na yung the transaction price kapag may various reason. And including na nga dito yung mga uncertain events. That's all. Thank you.